Good morning, everyone. Welcome to a Sunday special post Easter. We back at our usual time, almost usual time, and back with the full team: Helen, Adam, Ross, and Jay.
Hello.
Morning, everyone.
Morning, everyone.
Yes, today is we're gonna start with the usual thing and the Adams kind of supplement recap for those who haven't read it yet on the Partners in Property community page, and also we're gonna discuss some things in the come up, possibly some new asset classes that are emerging, and that might be one of the things that we might venture into. But we would welcome comments and questions and things that are going to stimulate the conversations and get us going post Easter.
Yeah,
so
let's make it interactive.
to make it super interactive, especially we're on like 3 different channels. We're on Property Sisters, we're on LinkedIn, we're on Facebook. So you guys send your comments in. Brilliant. So, Adam, what do we start with? I had this. There's a quote from Pope Francis. What inspired you to be like how to say it, spiritual?
Sunday / Easter season appropriate, I think, is probably the
sermon.
The way to. But I felt, I know from a few chats and conversations I had with people this week, they were picking up that some of my tonality of late has been a bit bearish around the wider economy. I'm definitely not in a particularly contrarian position there. There's lots of the bear signals in the stock market, just in terms of sentiment rather than what's actually going on, are about as significant as they ever are. I think we hit something like a reading that we've only seen around 1990 and 1978 maybe, or something like that, winter of discontent sort of time, in terms of what investors are thinking. And of course, a lot about recessions in general is self-fulfilling prophecy, because it is about expectation, and so we do need to be careful. But I think where I'd been unclear, which I tried to clear up today, was I'm talking about economic recessions. I'm talking about them because I'm obsessed with the macroeconomy and the results that might have on the property market and just investing and asset classes and money in general around the world. Really, it's a real passion of mine, as you know. And I think people were starting to hear the R word, which I'm still at not our usual R word of rhubarb, of course, but the other R word of recession. And also, I should be clear, I'm still 50-50 on whether there will be one over the next 18 months. So there's no guarantee. I absolutely detest people who predict a recession at the drop of a hat. Ross will attest to, I actually fell out with someone quite significantly because about every 9 months he would predict a recession. And one time I had the temerity to poke a bit of fun at him, and he took it the wrong way. So that blew up into something that it shouldn't have done, but hey ho. And recessions don't mean necessarily property prices falling, certainly in nominal terms. But there was a bit of a maths lesson, I like a quick maths lesson on a Sunday morning as well. So there's a bit of a maths lesson about why leverage is just so powerful in times of inflation. And even when we could see graphs where real house prices, so house prices adjusted for inflation, could go down, 5%, even 10%, and prices could still be going up because inflation is so bloody high at the moment, apart from anything else. And this is before we really get into the next phase of this cycle, which is probably most of the pandemic stuff has worked its way through. The Ukraine-Russia situation is much more difficult, I think, and that's probably something we can have another pop at another time. But most of the pandemic hangovers have worked their way through the system, let's say. But are we at a stage then where people are, what normally happens, especially in tight labour markets as well, is that employees demand big wage rises in times of inflation. Public sector struggle to do so, but of course they've been taking it double barrel since 2009. Arguably, if you spoke to someone who's worked in the public sector for 40 years, they tell you they've always taken it since then. But they've certainly taken it badly in the last sort of 13, 14 years. So I don't know how much more punishment they can generally take. And the private sector, whilst you've got sub 4% unemployment, there's limited wiggle room for employers. And then, of course, you've got costs of employing people going up and up and up anyway, with extra national insurance and this, that, and the other as well. So there are a few things that could change that, and that next phase will be really interesting. And that hence the 50-50. I don't really believe that world-class stewardship from the Bank of England and the Treasury, although I think it's been pretty good the last few years. I've been fairly clear about that. On their own, they can't stop a recession. In fact, they have a woefully small impact on these things, as much as they like to think they have a large impact, and that's not good for their PR machines. They actually have a woefully small impact because usually it's an external shock that slides down. I spent some time with Ross earlier this month, which was great. One of the bits of work we did was we watched The Big Short together, which I always consider as work revision, and I always learn something every time I watch it, and loads of things, to be honest, because I didn't live through it as a trader or anyone really particularly connected to financial services at the time. I left wealth management in 2006.
So I think what we need to do is we need to rename this Sunday special to The Big Short episode 5, 10, with like a Netflix thing. So it will be Adam going through the sensing the recession.
I think Jay would play a fantastic Dr. Michael Burry, to be honest with you. I'll probably end up as Steve Carell's character, that really aggressive guy who upsets people by shouting at them. Yeah, that actually sounds workable, to be honest. I think that's a good shout.
And who's going to be the stripper that owns the 6 houses in Miami?
You. I thought that was a banker for you, mate, to be honest. I didn't even think we needed to mention it.
So it was filmed, but the question I asked Adam at the end of it was, were you aware of any of this that was happening? Because it was centering around 2006 and 2000. Whilst I was still driving around thinking I was talking to the property developer, doing my deals, having my houses, having a holiday, all that stuff. People are hiding things from you. And so I was saying to Adam, were you aware of this? And that's ultimately, he's like, I wasn't aware of any of it. So it just shows it is quite important.
And I think I also said to you, Ross, at the time, or certainly the year after it had all kicked off, the contrarian in me saw the FTSE under 4,000 and thought, blimey, if I had the capital at the time to be wagging into it, I'd have been getting absolutely stuck in. And I went to have lunch with a friend of mine from school who was really the superstar student at our school, who went on to do economics at Cambridge and then went into investment banking. Super hardworking, super numerate, really good communicator, just an all-round superstar. And he'd actually approached his boss, he was at Morgan Stanley at the time, in late 2007 to say, right, we need to go short subprime. And he was the head of a prop trading team. So, I mean, he was pretty senior, and he got blocked from making that trade because they were so long on subprime. And so when he made no money, now he made either, I can't remember whether it was 70 or 90 million euros for the bank that year, and he got no bonus because they'd lost money. Why did they lose money? Because they were long subprime. So he knew it was coming. And I think The Big Short kind of shows you the later on in the process. It's the beauty of Christian Bale's character is that it's just so factual to him. He sees it as, but this is going to happen in March 2007. But of course, what even he didn't see is just how long it could be stretched out by the market, by the big players, how much it could be manipulated and carry on, more than another 12 months. And that's one of the things that I've tried to sort of allude to today as well in the supplement, because this is what I really love about property. You get time to do things, and that means you should make fewer mistakes. And it also means the old, I'll tell you, I might blow next week's quote now, but it's probably time for one of my favourite John Maynard Keynes ones, the old market can stay irrational longer than you can stay solvent. And of course, a lot of the Big Short is based around that. These guys are actually struggling for liquidity, they're struggling for support. There's that brilliant bit where he writes the email at the end where to his chief investor and says, your profit of $489 million is going into your account today. You're welcome. Because the guy's been harassing him and haranguing him and basically saying he's rubbish, he's got to liquidate his positions, and he's just exercised his agreement as the fund manager to say, nope, this is going to make money, guys, just got to wait and see when it is. And of course, all the fiddling around that went on at the big houses where they were continuing to sell horrific products to people whilst they finally got on the train and realised they needed to try and reverse their positions without enduring even bigger losses than they already would have done. Otherwise, if they hadn't done that, JP would have gone down, Goldman would have gone down. There's no, Buffett wouldn't have been able to save them. It would have been a really, really big bloodbath. And the other favourite bit that it reminded me of when we watched it is at the end when they go, and of course, all these people went to jail and this happened and that happened. They said, oh, no, they didn't. No. One person, one German guy or Swiss guy, whatever it was, one went to jail. The rest of them carried on, waited for a while, swept up, changed the name of a couple of things, and then cracked on with business is what happened. So it probably, or I don't even think probably, it is the single greatest educational film of all time in finance. It is a spectacular piece of work, and I couldn't recommend it any more highly. And I think I might even watch it again tonight. I'm so excited, to be honest with you, by just talking about it. So I wanted to be clear about where I think the recession might bite. I wanted to be clear about why property investors shouldn't be panicking. And I wanted to be clear about, a time of inflation is the best time to be in property because of being able to get nominal debt quite cheaply. But one other thing that I called back to, another post that I put up this week, was around, look, we're not speculating on this stuff. Again, in the kind of Big Short way, I'm not guessing. This stuff has happened, right? You will see stuff happen on the basis of what's happening. But the gap up in the bond yields, which makes the interest rates more expensive, we're talking, 0.25%, maybe 0.3% at the moment in terms of people's 2-year fixes and 5-year fixed mortgages. You'll start to see that happen over the next 4 to 8 weeks. The only thing I'd be guessing on is the timing of the slabs of money. So it's even more important to the nut low is over. That's now a fact. One of the considerations that you have to have is this gap up in the bond yields the first of 3, 4, 5, 6, 7 gaps up in bond yields. And there have been at least 2 in the US market already. I haven't followed that on a daily basis, but there's been at least 2 in the US. And this and probably one more thing I need to clarify. We're talking basically till the end of 2023. Generally speaking, I'm talking about right now. If we go into recession, remember it takes 6 months to go into recession just from a technical perspective. If we go into recession, I would not rule out the base rate coming right back down again. So there's a greater than 50% chance that would happen. So this isn't goodbye low interest rates forever. I think if you read today's piece, I talk quite a bit about the early 90s because I'm a big fan of looking around at what's happened and not just calling back to the last crisis or whatever, because that's probably the worst way to analyze things, I think. And I remember as a child, when I was educated about saving money by my family, we would be given a few pounds, or we would earn them by clearing my grandma's house or something like that. And we would go to the National and Provincial, as it was at the time, which was a building society. And there was a few lessons in there because we could lock our money away for 5 years and get about 7% interest. So I'm talking about the late 80s when I was a kid. And at the time, the base rate was actually in the double digits, up to nearly 14 at some point, 15 in the late 80s. So they were mugging us right off in those days. The savings margin was absolutely gigantic.
And did you already know that being a child?
I didn't know. yeah, I knew all of that. I had it all under control. I was writing the supplement back then, but it was on paper, I'm afraid. And no, I had no idea, of course. But what I did realise quite quickly is that was also around the time some of the building societies demutualised and or IPO'd, if you like, for want of a better explanation. And the carpetbaggers, including, I realised what carpetbagging was pretty clearly, where my mum was taking me around putting a tenner in this and that building society, hoping that we might be able to cash in on some of the windfalls that some of them were getting. But in those days,
that's why I had 10 bank accounts by the age of 10, exactly because of that.
I think the only other reason I had a NatWest account was because we could collect those pigs. Do you remember those pigs that they're now worth a bloody fortune? Unfortunately, I've only got baby pigs still. I don't know what happened to the rest of them, but I remember having the big fat banker pig in his suit was like the chief Lord Nathaniel or something he was called. I remember it well. But that was my sort of savings education. But looking back on it now, all the margin was still on the savings side because the rates were so high, they would badly underpay the savers. And then the mortgages, whilst they were high, they were actually below the base rate, quite a few of them. And that phenomenon lasted until 2007, where people had, or 2008, where people had discount tracker mortgages. So they were tracking the base rate minus 2%, up to minus 2%, some of them. Some of that was Northern Rock stuff, I think, that was put into UCAR. But there was plenty of banks doing discount trackers on base. The whole business model, and I've not really seen anybody write about this, which is probably one of the reasons why I write the supplement, to be honest, but the whole business model's flipped completely on its head. And now it says, well, do you know what? You've got money, good for you, but unless you keep earning or put it at risk, it's not going to make any money. In fact, it's going to lose quite a lot in real terms. And now, as we speak today, it's losing a hell of a lot in real terms. And that would need an event to flip that back on its head for longer term interest rates to go back to the days of 5-6+%, or a very, very buoyant economy, which at the moment is really, really difficult to see because we've done nothing in terms of serious productivity gains since 2008 in the UK. You know, we're woefully short on that stuff. So it's really a tough situation, but that doesn't mean properties are better than it's ever been compared to a lot of other asset classes. But I know we said we might segue into some of the alternatives and some of the new ones later on in this chat. But that's what inspired me to channel the Pope this morning anyway. So thank you.
I mean, that was probably more words than the actual supplement itself, which is by no means anything less special. I mean, I was going to butt in, but you were doing such a good job. I kind of thought I'd hold a couple of my points right to the very end, which is like sitting on a rocket. It's not comfortable sitting there going, I want to say something. Not that I disagree with any point, but in 2006, 7, 8, and almost 2009, I was working with family. And one of the uncles that I worked for, there was a big office that we had, but he insisted on working at home, and he had 12 screens. It was like one of those old 80s films where, like, it wasn't for group calls, it was for, like, it had Bloomberg, it had like all of it, and he was watching everything. And he was very much like you, Adam. He was just 6 foot tall with no charisma. That was the only two differences. Brilliant intellect, just no charisma, and maybe the lack of charisma was the thinning air the higher up you go. Who knows? Maybe we'll get scientists to talk about that one day.
Don't tell Rob that, otherwise he'll be very sad.
He may just be an exception to the rule. I think maybe because of his bulk, he can hold more oxygen. Maybe that's how he's doing it.
Spectacular recovery there, Mr. Howard. Spectacular.
Well, I can dig myself out of most things given half a chance. But he always used to say, like, he didn't predict like the financial crash or the recession or anything like that. But what he was very good at, he was like, he said, all I'm doing is I'm following the flow of money. Money is like energy. It doesn't just disappear. it just dissipates. It's repositioned. It just goes in a different direction. And he was looking at stuff in like 2006, and he was like, okay, we're going to come out of this and we're going to move into this because I'm feeling less bullish on it. And he protected, I can't remember how many billions. He predicted like X number, like I think it was like 30% of the portfolio, which wasn't insubstantial. He protected that almost completely. And they went against, a couple of 100 years worth of rules about not selling, about trading, refreshing 5% of the stock every 3 years. And he broke that, and he maybe refreshed about 15% of the stock in a 18-month period. So he really went bullish, and it paid off. So I wanted to just kind of like mention that as it's kind of like, even in situations like this, it's not where the money is now, it's where is the money going, right? Because you want to be there earlier doors.
And that's a really good point, actually. When I say all these people, and you get inbox about doing foreign exchange and do this, that, and the other. That's the whole point. That flow of money and watching where it's going to kick in, because we have an order book. When you're sat on a trading floor, there's an order book, and you can see at what levels people are going to buy and going to sell. They've got stop losses, they've got take profits. And that's what an investment bank has access to that information. It's why I talk about asymmetric information all the time. If you're sat at home with your one little screen, and you think you're going to get ahead of that market, when they know exactly what's going to happen whenever those prices are hit, you are dreaming. Or you are, I don't know, you're channeling something from some other world. But it's exactly that. It's following that flow of money. And that's what this is completely legal. I've made it sound a bit dodgy. It's not. People have orders because they need to buy and sell and hedge at all different price levels.
Yeah, it's not like you don't know every single thing that's going to happen. You know what's going to happen in your order book.
Exactly. For your order book and your clients. But you can make inferences about what's going on, and you see price action of what another bank is doing, and kind of what's going to follow. So, but following that flow of money is so critical.
That's how market makers make money, right? That's why you can do it. So this is another segment in that why people are sometimes dreaming, or not necessarily dreaming, but don't understand the enormity of the task that they face if they're going to take money out of those markets on a daily, weekly, monthly, annually kind of basis, is the opposition that you're up against. And the margins, they can work to thin margins in gigantic volume and make big money. But if they're making money in a zero-sum game like Forex, right, and they've got all that information, there will not be, there's a loser on every side of the winning trade. And that's why 76% of eToro accounts or whatever are losing, even though most of them are trading stocks which actually go up on average at 8% a year in the long run. And people still manage to find a way to lose. More than 50% of people find a way to lose, even in a market which isn't a zero-sum game, So that's not to I was trying to think of a better phrase, but I can't think of one. That's not to piss on the chips of everybody who wants to try and trade and make money from this sort of stuff, but it is just understanding of the respect that you need to give the other players in the marketplace if you're gonna play that game. And there's a great book that's great for Audible as well, because you can listen in chunks. You definitely don't have to take it on all in one go. Called Market Wizards, and it's old, it's from the, I think, mid to late 80s, which in itself makes it really interesting to an economic history geek like me, because you know what's happened since then, apart from anything else. But it's really interesting to hear and see and analyze the behavioral traits of the super traders that are interviewed in that book. I think there's an updated one actually as well, but I've not actually listened to it or read it myself. But there are people say to me, what are good books for learning about this sort of stuff, about really learning the reality of things like trading. And I'm a big, the famous Edwin Lefebvre one, Reminiscences of a Stock Operator, is pretty good. And there's another great one called, I think it's called The Hour Between Dog and Wolf, which is written by a trader, which has got some really good stuff in it. And Nassim Taleb's Black Swan,
Black Swan.
is
Yes.
also spectacular insight to that sort of thing. Although I find Taleb very, very difficult to swallow if you follow him on social media or anything, because he's one of the world's great narcissists, unfortunately. He's got an awful amount to add when it comes to how to survive as a trader for a long time. You know, he's pretty spectacular sort of approach to the game. And if you don't think you're up against those people, if you're playing in those markets, you're kidding. And it's a bit like what I mentioned before, you know, I upset someone because they said, well, I was up 78% on Bitcoin last year. And I was like, great, but Bitcoin's up 568%. So that's not that good, is it? Really, to be honest with you. You've got to benchmark yourself, right? And that's, therein lies the problem, in that if you're always going to underperform the market by a scale factor of 5, then you know, might as well buy an ETF, mate, or whatever, and just sit back. And that's probably, and that's why Uncle Warren tells people, most people, that's what they should do. That's what they should do. But anyway, small rant over.
It's brilliant as always. I mean, the other point I was going to make is I know someone who works in e-commerce. They're very experienced, and they worked on the tech side, the sales side, the management side. Like it's what they're passionate about. And the news obviously has been breaking over the last 5 years about Netflix losing their viewership. You know, they lost about 200,000 like 2018, 2019. They've recently lost another 200,000. And the chap that I was talking to about e-commerce, he said, well, he was looking at some stats that Shopify had sent out. So Shopify is they kind of manage, they have a centralized shipping account and all that kind of stuff. And people kind of use them as I'm trying to think what the word is, begins with them, beside the point. And they kind of facilitate all of that on their websites and through social media and things like that. And he was saying that they're seeing massive losses. They're seeing orders being cancelled. So you're starting to see people are thinking, right, there's all this news about fuel poverty that I think is actually, if you're looking at the last 2 or 3 recessions, like the last recession, nobody thought it was going to affect them. They're like, oh, this is the subprime market. They're talking about America. Like, what has this got to do with us? This, you know, I'm not going to use the word recession. With inflation being so real already, and with the doomsdayers and even like heads of national kind of energy firms coming up saying this is too big for us to deal with, you know, these are like real things that people can go, right, if my bills are £60 a month and they're now going up to £200 a month, that's a real thing. So how am I going to mitigate that? Well, that £140 differential between what I would have had left at the bank at the end of the day versus what I'm going to need. And then, you know, spurious things. And now just people are starting to look at cutting those down. And I think that's a real thing. If that becomes something that's less than localized and becomes more national, and maybe the figures are, I've not seen them, but that's something that can really affect GDP.
Yeah, my view is that this will be one of those situations where we look back, like you've had a few of these in COVID, where you kind of thought, oh yeah, of course that's happened, of course it has, you know. And what happened to GDP, you know, and the trouble is the noise is so great because of the lockdowns and everything else that you don't get these finer points and nuances. But what happened was, you know, the service industry drew back a bit, but goods consumption of goods was up massively, unsustainably, and there are a number of reasons for that. You know, there wasn't other stuff to spend your money on, like experiences and entertainment and holidays, and so it's kind of like, okay, so you bought Peloton because it would give you what you got at the gym and a bit of fun at home if that's your bag, you know, or you bought a hot tub or you bought, you know, the ton, which actually takes quite a bit of energy to run, interestingly enough. So, you know, you've got all these things that layer up, and there's an inevitability which, just because, and I suppose you could look at this in the same way that the lockdowns affected working from home, you know, suddenly, comparatively overnight, nearly half the jobs in the UK were being done from home, right? Because they could be. The other 50 to 60% couldn't be, but that they were, and it just happened like that. And it was, I think, pre-pandemic, 6% of jobs were done from home It went to nearly 50. It's come back to more like last time I saw the numbers, we were in the below the low teens, about 11%, I think. So nearly double what was happening. And of course, you can't measure it by yes or no. You've got to look at you need to look at data in the office, and you need to look at, there needs to be some better data when that starts to be getting put together, when things really are normalized again, which I think we're pretty close to now. But the same goes for e-commerce. You had 5 years of growth, they said, in 3 months, didn't they? But that doesn't guarantee that there won't. The trend is upwards. The trend is upwards, but there'll be a correction down before we go back on that upward trend. And that's and the thing is, because people have relatively short-term thinking, and also they've had to run much bigger inventories than they have done in recent years, because just in time has fallen apart in so many different industries as well. You're probably seeing more risks being taken by some of these e-commerce firms than they otherwise would have been taking. It's not like you have the luxury of drop shipping everything you want to, because you can't get the stuff in time. So you're stuck with the Oak Furniture Land style model, where you get all the stuff over from China in containers, and you're paying 3.5 times as much for your containers still as you were 3 years ago. And bigger inventories mean bigger drag on return on equity, performance, etc., 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 which in a time where investments really struggle in a time of inflation like it is, and I've talked before about post-pandemic periods, the historical figures dictate labour does well, capital does poorly in comparative terms compared to pre-pandemic environments. All of those things together lead to a really, really challenging environment for people to work through. And of course, because e-commerce has absolutely blown up, the other problem is a friend of mine who's got it was a high street retail business they took online a few years ago, had a good lockdown, but they started to say in the trade, they tell me that the vernacular is, you don't have your landlord on the high street anymore. So you haven't got your business rates, you haven't got your rents, which you consider to be too high, but they've got a new landlord, and it's Google. And the trouble is, Google are better than their high street landlord at extracting absolutely every penny they can out of them via pay-per-click, etc., etc., etc. And it's a really, really tough game to play unless you're quite talented in that space. And I mean, Roth knows a ton about that stuff, but we all see bits and bobs of that in so biggest landlord in the world, not on the Pope theme, maybe not the Catholic Church anymore, but perhaps Silicon Valley's finest.
Yeah, that's stunned everyone to a bit of silence. Go on, Ross.
I was back in the UK going through figures for the start of this year, and the cost per click of acquisition for leads for one of the businesses is 4 times higher than it was this time last year. There's nothing, absolutely nothing you can do about it. And the choice is, do you pay the money and hope it all comes good, or do you not pay the money and get nothing? You have no choice. It's a horrific situation, because in effect, where the property businesses and estate agents and things, stock is leaner, the market's going really well. Most estate agents of below this kind of critical mass line are struggling because they don't have enough stock, and yet the cost of acquisition for the immediate piece of stock is 4 times higher than it was. Where do you go? So in effect, Google is going to kill certain businesses because they're able to, I think the lovely expression is, nick all the sugar out the tea. And if somebody from Google sees this, what's going to happen is my cost per acquisition is now going to double again.
That's it. So I think this is a good kind of transition to like that conversation about some kind of new asset classes that are being kind of considered in the market, because one of those is actually like data centers. And data centers are a bit like logistic warehouses and retail spaces. It's considered like an asset class. It's not a warehouse for servers, it's a data center. And I think the way things are going, it's it's kind of moving the capital into people investing in those things, and there's a lot of money possibly to be made in that. What would you guys think of this new asset class?
Do you know what, Piotr? I'd just like to kick off that segment by bringing it back in another way to what we've already been talking about. Because
Yes.
one of the things, and I have seen the word, but I can't remember the word that is being used. It's better than the word I'm going to use, but deglobalization, right, is a thing that's going to be even more. What'd you say, Ross? Sorry.
Decentralized.
Right. So that the move away from, for example, in the pandemic, when it became clear that 90% of the prescription drugs in the US were made in China, for example, and the fragilities of that, and then what a Putin, Russia, Ukraine situation does on top of a very fractious foreign policy. You know, there's quite a few people who, and if I'm being cynical, 50% for YouTube clicks, 50% because they mean it, have been talking about World War III for the last 12 or 18 months. What they're not doing is being sensational about it and saying that equals global thermonuclear war. It's fought on a different battleground these days, but the potential for, because ultimately what happens to the amount of data that there is, and there's a whole, Google's been carbon neutral since 2006, which in itself is just utterly phenomenal. But given the amount of energy that they actually use, and every email that's sent is stored on a server, and all the rest of that, it's quite phenomenal. But of course, some of these data centers have tended, a bit like, I was listening to a podcast this week and they were talking about commodities, which is a good, not a new asset class, but something that's behaved very interestingly in the last couple of years. And they made a really good point I'd not thought of before. They said, look, the vast majority of things that are mined in the world, precious metals, base metals, whatever, oil being included, comes from not the most desirable places to live by any stretch of the imagination. And so it's quite an interesting dynamic that people don't necessarily consider. But if you imagine, you know, the EU's talking about, do we stop using Russian oil by the autumn, and things, now that it'll do something to the oil price. I tell you, there's going to be some upside if that sort of thing happens, because the Saudis have not said, but it's what they've not said that's important. They're not saying, yeah, we can meet that production gap that it would leave, which basically means that they can't. And also, there's a lot of problems with types of oil and grades of oil that are normally lost on the, you know, we talk too much about the price of a barrel of oil without realizing you can do things with sweet that you can't do with West Texas Intermediate or whatever. You know, nuances that I don't understand because I don't trade oil. But all of that feeds together into maybe don't have as many things going offshore as you did. And data would be a really, really big one of those things that we don't necessarily appreciate. Now, there's also got to be, and I don't understand the nuances of it, there's also got to be a Brexit factor in play in that sort of thing as well, because GDPR, I believe, had some impact on where data would be stored and how it would be regulated. But of course, outside the EU, there is scope to change some of that. So it's whether we decide to force a lot of this stuff to either stay onshore or be re-onshored. And then, of course, all of these things have a massive cost implication at a time when we don't want things with massive cost implications. So to be in power making that sort of level of strategic decision, but it's probably easier just to have cheese and wine and go to the occasional party, to be honest.
I have to say, like, I was talking to somebody and they were like, they were saying how bad a job government's been doing over the last 10 years and blah, blah, blah. And I said, look, there's, you know, it's a difficult calculation. I mean, Adam, you mentioned earlier, like kicking the can down the road and stuff like that. They've done a very good job of like kicking Brexit down the road for it to not have such a single point of like cataclysmic error in the market. It's kind of, they spread the load across. You couldn't have really predicted COVID, and they've managed to kind of pump enough capital into the market for that to be spread across as well. But you know, it's a very, very strange market. It's a very, very strange market.
And in all fairness, Jay, I am taking a cheap shot there, because the reality is at the very top level, these things are really hard to solve, and many of them are too hard to solve. I mean, you take 1.7 million homes short based on official government figures. In the private sector, 5 million on social housing waiting lists, right? There is no answer to that, because the answer of, well, just pay for it with government money, it's like, oh, okay, yeah, we'll just borrow £1 trillion to do that. That'll be fine. Can't see a problem with that. Yeah, that's fine. It's not the solution. And there's not one silver bullet solution to a lot of this stuff, which is why we end up with these horrible legacy systems. Why education has got so many holes in it, why healthcare has got so many holes in it, because no one really wants to stand up and say, and you wouldn't want the housing minister to go with this sort of mindset, but do you know what, guys, we're never going to solve these problems, so all we can do is try and mitigate them and get things going in the right direction. And no one's even been able to do that in the last 15 years. We can't even go in the right direction, let alone ever pretend we're going to meet those gaps. And that's just housing.
Well, I think the idea of data being a commodity that you can house and charge for, and having that in this country is good, because on an international basis, we import a fair chunk of everything, really, and what we're really very good at is we're very good at financial services, which is a big old chunk. That was quite a divisive point in the Brexit talks and decision making, blah blah blah. And we have housing, not just housing for people in the country. It's a massive investment tool for people investing externally into the UK. And I think the government has to walk a very fine line on. There were talks at one point about doing compulsory purchases, or not even compulsory purchases, just taking assets from Russian nationals that they feel are connected to the Kremlin or Putin, and just taking them away. And I was sitting there thinking, this has got to be like the worst thing that they could possibly do, right? Because the moment you weaponize property in the UK from foreign nationals, it reduces their confidence in thinking, right, I'm going to have property all over the world, but in the UK, I know that my property is safe from X, Y, and Z, and all that kind of stuff. But there comes a cost and value kind of metric in that whole part of the conversation, because between Russia and the Ukraine, and how the rest of the world is dealing with it is economic sanctions. And economic sanctions are a value basis, right? What is that value, and how do we restrict that value? But the problem with that is actually the cost of that is human life, because while they're applying economic sanctions, they're supplying military weapons. So, and it's kind of like, well, where is the problem being solved then? It's the same situation as, well, why don't we sit back and have an OFE party or a meeting in the garden and in the middle of COVID or whatever, and we'll call it whatever we want, and we'll be confused about what it is and blur lines and blah blah blah. Or that there are commodities around the world that are doing really well, but do you want to move to Rwanda to farm them? It's that kind of situation. It's interesting. I've not got a clue.
I think one of the interesting things specifically about data as well is, I forget the name of the principle now, but we double our processing power every 2 years, or whatever the general trend has been. And you would think, well, does that mean, because a lot of the kit that's going into these sensors is very state of the art, as we were talking about earlier, does that mean you've got a problem because the size starts to shrink? Or have you not got a problem because more than double the amount of data is being generated and created that's worth storing in the next couple of years? So I'd want to understand a bit more about that relationship before I got sort of stuck into it. But you can see a lot of mileage, and apart from, you're probably going to want to make sure you've got some solar PV and some stuff, because I imagine these places have a reasonable cooling requirement apart from anything else. But if there are some nice long leases, you wouldn't think the game that, it was very clear to me. We've gone, 45 minutes. I've not mentioned my MBA yet today, so I'll break the habit of a lifetime and just slide it in. But in 2012, when I was doing my MBA at the very fine University of Warwick Business School, one of the things that was very clear that was big data was going to be a really big deal, and what they could do with some of this stuff. And all I've really seen as not someone in that game, I obviously am obsessed with data, but data that's available at a fairly national scale, and then the data that I've got within my own business. The only real application of a lot of that stuff that I've seen, a little bit of it in e-commerce, but mostly Facebook advertising. That's been about the size of big data so far. And of course, there's a lot further to go. But the point is, there are applications in all sorts of businesses and industries that aren't really being used yet. I mean, again, 10 years ago in my MBA, we were talking about wearables and how big they'd be for healthcare. That hasn't really emerged yet in a meaningful way. Now we've had a pandemic, healthcare is absolutely blown up and is at the top of people's agenda. There's going to be giant requirements for that sort of stuff in the next 10 years or so. But if you're on the concern side of the fence about some of this stuff, there's a great Joe Rogan podcast with a guy who is obsessed with this stuff, who will tell you exactly what he thinks of what Google are doing. And, he doesn't use any of that stuff. His smartphone is completely free of all cookies and all the rest of it. I can't remember what his name is. I'll have to look it up and put it in the comments. But it's an interesting one, because it's one of those ones that makes you think whether you need to go and live in the mountains and live on cans and tinned water or whatever. It's interesting stuff.
Well, on the the last real kind of scandal with data was Cambridge Analytica, where you mentioned Facebook. That level of data. It's because that was basically looking at it. It was almost behavioral software that was starting to predict trends based on people's interaction, based on flag words that they had put into the system and stuff like that. It's really very smart, but at the same time, it's like it's a step below scary.
I was quite scared, but I did one of the tests that was around at the time to say, well, they can tell all this stuff about you, and they thought I was a 47-year-old woman who voted Labour. So I was quite pleased that I was somewhat missed the mark on that front, realistically. So
well, look,
I thought only on a Sunday,
life.
Susan.
None of us are going to pry into your personal life, Adam. What you decide to do on evening and weekends is you, okay?
I've got my heels on, Flower, and you love it. You love it, Jay. Come on. But yeah, well, that there's got to be some mileage in some of that stuff. But in terms of, I mean, it's where you go with the idea of alternative asset classes, isn't it? Really, because do we even accept that cryptocurrency as yet is its own asset class? I mean, arguably, bearing in mind, gold isn't really, because it doesn't yield anything. Now, of course, some cryptocurrencies do yield, but they yield themselves, which is the concept that's reasonably interesting to get your head around. And then some of the transaction fees are so high, it makes it difficult to do anything other than speculate in crypto. And that's probably I listened to an amazing podcast the other week that which they were talking about Ethereum and the bridge between, I can't remember the terminology because I really nowhere near as clued up about this stuff as I should be, but why Ethereum was the most interesting cryptocurrency, because they're going to go from, Helen might know what I'm talking about, time to something from time to something else in the way that they transact. And that's going to be potentially a really big game changer. And of course, the guy who started Ether is one of those stupidly clever individuals that you just think, how are we both human beings? Because he's just from another world. He's a bit like Sam Bankman-Fried, who I was listening to a little bio about the other day. The guy who was, billionaire in his 20s because he was buying bitcoins in Japan or buying him in the US for $10,000 and selling him in Japan for $11,000 and doing like 20 million of transactions a day. I was like, wow. where was I asleep at the time? It's one of those, it's like watching The Big Short and thinking, I missed my calling here. Why was I not in Manhattan? What did I do wrong with my life that meant I wasn't in Dr. Michael Burry's office saying, yeah, I reckon we can have a go at this fun. Yeah, it looks all right.
That's how you trade FX, doing something like that. That's the
exactly. Arbitrage at the very highest order. Yeah, it's a bit old school Nick Leeson, Singapore, Barings Bank. It all came to mind. All my favourite words in one sentence. The 5/8 account, the whole lot. But yeah, I mean, so if you don't include crypto in that discussion, because there's a number of reasons why you could say it's really interesting at the moment, because there is a case, I think, for explaining what precious metals have done in the last few years, which have been contrary to what people would have thought they would have done. And even every time gold sort of tests these highs at $2,000 and stuff like that, it still pulls back, and it's really underperformed given, supposed to go up when things are uncertain. I mean, come on. Have you seen the last 3 years, And it just hasn't really performed like that. But has crypto made enough of a dent? Because the worldwide gold market is not uber gigantic. There isn't that much of the stuff. It's not like the global bond market, and it's not even in the same conversation as the global derivatives market. It's a relative triviality in comparison in terms of its market cap size. So it doesn't take that much to dent some of the traditional gold related moves. I don't know, what do you think?
Well, I was just thinking, I think it will be really interesting to watch from now the ruble's been pegged to gold. So that's we'll see how that one plays out. Obviously, Mr. Brown sold all ours off, so not necessarily a great move, but
geopolitics.
There's a bigger story going to evolve there.
Yeah, really, really, really interesting things to consider.
Silver's the one I'm watching at the moment, and just reading and understanding about all the and it is just speculation. I'm still trying to kind of digest the information, but how much the price of silver is still manipulated. We've seen all the scandals in banking about there's all sorts in foreign exchange, right? And the fixes literally being fixed. And I'm reading a lot still about the price of silver being artificially kept low.
Well, I always remember those two brothers who basically just tried to buy all the silver, and it was just a sort of mad idea you imagine having in the pub at sort of 10:30 at night and thinking, well, why don't we just buy all the silver? Just buy it all. Because I was talking to someone about this at a Bristol pit meeting on Friday. If you've not seen it, the Netflix documentary Sour Grapes is, again, I consider fun, educational watching. And I'm not going to blow the whole gap, but what it teaches you is if you can control a market in one way, shape or form, ideally it would be legal. That would be ideal in that situation. It's not always so, hence the silver guys, and hence just watch Sour Grapes because it's worth watching if you can find it on YouTube or on Netflix or somewhere else. But if you can control or even influence the price at which something is traded in a significant way, the potential rewards, whilst you're borderline insider trading or whatever, it's very, very interesting what can happen. And you need to be so careful, because even in the big boy markets like oil and things like that, there are bank holidays and certain days of the year where the price is still manipulated quite significantly. And that's why when we're in May 2020 and everything was really going south, and in the future, that's why we got to minus $37.48 for a barrel of West Texas Intermediate, because all of these things kicked in. They were in a place which they didn't understand and didn't know, and suddenly someone's left saying, so you're going to pay me $37 a barrel, and all I've got to do is get this oil delivered. Okay, well, I'll take May's entire supply of West Texas Intermediate. That's fine. But then, of course, you've got to have a nice big fat ranch in Texas you can store it on. Of course, there are logistical issues behind all of that. But if you're sitting on that, you wouldn't mind letting a few barrels of that go today, would you? Made a fair return on your. That's proper no money down right there. It can be done. It can be done.
Yeah.
Nice. We've got one question from Marius relating to those things. It's data centers. There must be something due to energy costs. Digital everything requires electricity. Is anyone concerned? What do you think?
Well, do you know what? I don't watch this on a really. I asked about the energy bills in our office. Right now, our office is a converted house. It wasn't converted by us. It was converted years ago as part of a development that they were doing locally. A big commercial development, putting an Asda in and a whole retail area and all that. And then when they were finished with it, pretty standard in £200 million development or whatever. By the time they were finished, they just sort of wanted to flog the office off. So if it was a house on that road at the time, it probably would have been 275 grand. And because it had commercial use, so there were a load of wrinkles. There's just a few little niggly legal problems that couldn't be solved, but they didn't need to be solved. It just needed someone to come in and buy it, really. So we ended up buying it at a snip at 160, and it's a great building. But we at times we've run 40 or 50 computers out of that building in our peak, and we still run a dozen, most with a couple of screens most of the time, and use the heating and all the rest of it. And I asked my business partner, I said, what are we spending on the electricity here every month? Because he was giving me some abuse because I was plugging in my electric car quite regularly, But I should be clear that I also donated a set of solar panels to put on the roof. So I do claim the. And I said, well, what are the panels saving us? And we spend about 65 quid a month on electricity. That's all with the PV panels. And you just think, I don't think the electricity consumption for a lot of this stuff is anywhere near what people think that it is. It's so low draw that it's just outrageous, really. So I think if you've got proper solar PV and proper insulation and proper all the rest of those things, and they are dedicated, of course it's going to matter. But then, of course, if you're leasing them out, then it's also going to matter who's got the responsibility for paying the bills, realistically. So you don't want your tenants to be suffering massive increases, of course. But I'm not sure the energy draw is quite as much as we might think. It's non-zero, but I would have thought they'd be not impossible buildings to be net zero carbon, with reasonable construction methods. So, concerned about energy overall, sure, absolutely, because we don't know where the lid is and we don't know where the end is. And you're always going to be concerned in that, same as I'm concerned about inflation, because we don't know when the peak is and we don't know how long it goes on for. And those are the things that always concern you, because they're out with all of our control, and all we can really do is watch and be quite concerned and try and help and try and think about things that make sense for the near future. But we are where we are with it, I think, really.
Yeah. Plus, I don't think the costs comparing to what the service is producing in terms of income and everything else is that massive. It's like a necessity, a bit like fuel for the airlines and stuff like that. It's like the airlines make enough money to like absorb the fuel costs and everything else. So.
Well, even down to grocery and how relatively little the price of the raw materials are for food, because it's the cost of delivery, the cost of logistics, and all the rest of it that are making a much bigger impact on the end value of food, rather than saying Ukraine's got 40% of the world's wheat supplies or whatever. Well, it has, but why is bread not £2 a loaf? Well, because it's a comparatively small part of the rest of the equation, and that's why we haven't seen the bread shock that was kind of predicted a little bit in the first days of the Ukraine-Russia conflict,
Yeah. Brilliant. Cool. Well, it's 10 past 11 almost. So I think we've covered quite a bit. And it's been well-rounded conversation. Do you guys think we're going to cover anything else? What's anything left to say?
I think if anyone's got any other thoughts on alternative asset classes they'd like to hear us chat through, then please leave comments, and we'll discuss next week, I think, realistically, or any particular requests for we can slag off politicians, property gurus, economists, other businesses. You tell us, we'll do it, no problem.
We'll do it with zeal and gusto.
In that
And
order.
props.
And props.
Brilliant.
Nice one. Great chat. Thanks everyone for tuning in and spending the time with us on Sunday morning. And we'll see you all next week.
Thanks, everyone.
Have a
Take
good
care.
weekend.